Okay, so this this is not what I want. I want my camera thing. Oh, that's not it. Pull this out a little bit. Sorry, I'm wrestling with my camera right now, and the camera's kind of winning. Okay, gonna set up a little bit. Now I know you guys have been through auditing classes before, but it's good to kind of go through a little refresher, and we will kind of go through and just kind of get the background again as to why we do this and how this kind of how it all kind of comes together. And start out with an example. This is the same example I use in my introduction to auditing classes, so it's a little bit remedial, I understand, but I think it's still good. Okay. This person is kind of an example of corporations. And corporations are actually somewhat new in that they really only they've been around for a couple hundred years, which sounds very old, but as far as stuff is concerned, it's fairly new as a form of business. Most businesses before that were fairly small. They had fairly few owners, but corporations were very unique. And in the past, if you wanted to have a corporation, you'd have to go to the state, and the state would create it. You just have to go to and have the assembly vote on it. It was a law to create a corporation. And now it's much easier to just file some papers. But corporations, they are a legal entity. They're separate from the owners. They're almost like a fictitious person. They're almost like a law created a person. And that person can do everything that you and I can do as far as business is concerned, except for vote. But a business, let's say IBM. IBM can sue people. It can be sued. They can buy land. They can buy equipment. They can buy theater tickets. They can do anything that you and I can do, except for vote. So a corporation is a legal, separate entity. It's created by the state, and there's a good reason that they have it. And the big reason here is limited liability. A huge amount of our wealth is because of this limited liability. And that if I buy stock in IBM, if IBM gets sued, even though I'm an owner, I'm not going to lose my house or anything. My stock might become worthless if the company, if the company goes bankrupt. My stock I might lose my investment, but I'm not going to lose my, house, car, boat, whatever. So that limited liability is a big one. That got encouraged people to invest in these corporations that needed huge amounts of money to work. Okay, granted by the state, already talked about that. Articles of incorporation, those are just the rules. Some of the stuff I could probably throw out, but they may have one owner or millions of owners. And that was another odd thing about our corporate business is that you could have the sheer number of owners you could have was really amazing. Where in the past, a large business may have tens or 20s of owners, that companies could have millions. Many companies could have millions of owners. And companies that need a lot of money to work, that's what they needed. Maybe privately or publicly traded, you can have a hot dog stand and have it as a corporation, one shareholder, or it could be publicly traded. So privately or publicly traded, either one is, you could have it. Publicly traded, in the United States, you have to jump through quite a few more hoops to do that. But you could have one shareholder, or you could have. I think there's companies that are, the way they're kind of set up, it goes 100 million. Sure, but anyway. Now, number 7 is the kicker, though. Owners do not always participate in the management. And this is the tricky one. This is where it kind of becomes difficult. In the past, owners would own the business. They would know what the business is doing. They would know how it's running. They would be part of it. They would be the ones doing all the work, and they would be the ones that would, they'd be the ones that would call the shots, and they would know exactly what's going on. With corporations, it's not like that. Many of the owners will never set foot in the company. Certainly, if I buy IBM stock, that doesn't give me the right to go walk into IBM. It's a separate person. Same way I couldn't walk into somebody's house. I can't walk into IBM because IBM owns that building, and I don't have any right to it because, even though I'm an owner, it's a separate person. So owners are separate from the businesses. And they may not even know how the business works. You don't have to. That's another great thing about corporations is, even though I may know nothing about computers, I can invest in computer businesses, even though I know nothing about them. So that is another of the great things about these corporations. Now, the downside is, okay, you're an owner, you own the business, you're at least part owner of it. Corporations issue financial statements to owners and to others. Now, here's the problem. You don't know exactly how the business is doing. You don't go there every day. If you own IBM stock, you don't go to IBM every day, unless you work there. But the idea though is that you don't have that direct line. All right. So problem is the business they're not actually managing business, and they're maybe unfamiliar with the actual management of the company. They don't know how the company is working, whether they're doing well or not. And B, a corporation's financial statements, they issue these financial statements, they may be fraudulent or misleading. So here's the problem. You don't know, mislead you, but an investor doesn't know, an owner doesn't know how the company is working, and they don't know if they can trust these financial statements. And this was when the corporations first came out. This is kind of a big problem because they would, it wasn't that uncommon to see fraudulent financial statements. Okay, so here's the solution to all of the problems. External auditors, CPAs. Now let's use a marker here. We'll audit the financial statements of a corporation before the financial statements are issued. So before they're issued to the public. So before, I think the example I give down here is IBM. Before IBM can send out those financial statements, they have to be audited by law. If it's publicly traded, they have to be audited. So before they can issue those financial statements, they have to have auditors come in and take a look at them. So IBM issues the financial statements. So IBM is the one that's issuing these. IBM makes all these. IBM will make the income statement, the statement of changes in equity, or statement of change in earnings, balance sheet, statement of cash flow bill. IBM creates all of these. The CPA firm will come in and make an audit. And in that audit, they will include any misleading information in the financial statement. So if there's a problem with the financial statements, and this is important, the auditors do not change the financial statements. So auditors do not change the financial statements. If there's a problem with the financial statements, you're going to tell IBM, hey, there's a problem with these financial statements. And IBM should correct the problem. If IBM doesn't correct the problem, it goes into the audit report. But the auditors never change anything with the financial statements. If they did, they wouldn't be independent anymore. You know, if they change these financial statements, they can't do an audit on something that they did. So auditors can never change the financial statements. They'll give suggestions to management, but management has to change the financial statements, not the auditors. And if they don't, it goes in the audit report. Okay, and that's what we're going to look at next is this audit report. Audit report is the last thing that's done in an audit. In an audit, you go through all those steps and all that. Yeah, so in an audit, you go through all the stuff. You do a little planning, you do the testing, you do you know, test control, substance testing, all that kind of stuff. You do the wrap up at the end, the lawyer letter, management letter, and all this other stuff. And then you make the audit report. All right, so the audit report is done at the very end. We're going to do it at the beginning of this class because it's kind of to show you what the aim is, instead of going through everything and then saying, oh, by the way, this is where we're aiming at. This is kind of, you know, this is what we're aiming at for the entire class, is this audit report. And that is on pages 2 and 3. And this is, there's actually 2 different types of audit reports. Right now, let me change my camera. There's the AICPA one, and there's also one for publicly traded companies. This is the AICPA report. The one for publicly traded companies, we'll get to that later on in the semester. But this is the AICPA, what they call the standard report or clean report. The new terminology is this. Unmodified opinion. That's the new terminology. That's the clean report or standard report. And this is the one that you'll use. This is for private companies. The terminology for private companies for auditing is they're called non-issuers. Oops. So there's a private company, there's a not publicly traded company stock, and the new terminology is that. These are for non-issuers. In other words, they don't issue financial statements regulated by the Securities and Exchange Commission. So these are for non-issuers, private companies. So Joe's hot dog stand would be there. There's also very large companies that are private, but you know, a small company would be a non-issuer too. Usually, if they don't have not publicly traded, they are non-issuers. So again, that's a terminology thing you see on the exam for auditing. Okay, appropriate addressees, people on the outside, shareholders, board of directors, not management. Why not management? Because management made them in the first place. Management made these. Management should already know what's going on with those financial statements. So we do not address this to management. Management should already know what it has. The first, let's even mark it. Okay, the introduction paragraph. And by the way, this format is kind of the one that you see for the AICPA throughout the CPA exam. Also, on the CPA exam, if they don't say that it's an issuer, assume that it's AICPA. The AICPA will find out, makes the CPA exam. If they don't say that it was a publicly traded company or an issuer, assume that it wasn't. So yeah, anyway, so this is for kind of what you're going to see for all of these. All right. So you start out, the first introduction tells us what kind of report it is. You have audited, so it's an audit report. Blurry. Okay. And it says that we have balance sheet, income statement, change of stockholders' equity, and it also includes notes to the financial statements, which is the new one. And the reason I put that, that's important is if they're gonna, when they do the CPA exam, they generally test on new things. That's relatively new to the rest of this. So notice the financial statements is included with the financial statements. So they're telling you, look, not only all these, but also the notes to it are something we'll look at. Now, honestly, to be GAAP, they have to include the notes, but they put it out separately as part of what they're telling the reader that they're going to look at. Manager's responsibility. This is the same every single report. This is management is responsible for the financial statements, preparation of the financial statements, and their internal control. So who's responsible for financial statements? Not the auditors. The auditors are not responsible for the financial statements. The company is, whatever the business is responsible. Management is not, the management is responsible for the financial statements and the internal controls of the company. What are the auditors responsible for, you say? Well, that comes up next. So, introduction. What's management got to do? What, this is, so for instance, I shouldn't put IBM because IBM is publicly traded, but whatever the management of the company would be in there. Now, auditor's responsibility. This first one, the first sentence there tells what auditors are responsible to do. And by the way, when you take the CPA exam, I got you. This is actually the first of 3 paragraphs. These are actually all together as one paragraph in it. I broke them out into separate sentences because they will often ask what paragraph it's in. That's really. I'll tell you something crazy. When people don't believe this, but it actually was. When I was going through it, now they had less stuff to know, but when I was going through it, we had to memorize it because they would say, write the standard. They used to call it the clean opinion or the standard report, and that would be one of the CPA questions. Just be write the standard report, and you didn't memorize that thing. If you did memorize it, and they put that on there, you did cartwheels going out of the place because you knew you passed. If you didn't know it, you went in your car and drove home because you knew that it was you weren't going to pass it. So you had to memorize that statement. All right. I memorized it and then they didn't put it on the exam. All right. So what do we have to do? We have to express an opinion, and that opinion is in that audit report, which you'll see at the end of this thing. But management does the financial statements. Auditors do the opinion, which is going to be in the audit report. So that's a separation there. They tell whose standards we followed. Usually for the United States, it would be GAS. It could be international standards also. If you're following international standards, this would just say international auditing standards. Or it could be other standard if there's some other organization that you're doing this for. Okay, and the third sentence here is probably the most important of the whole thing. It's so important, I'm going to make it in. It's yellow, I guess. Okay, those standards require that we plan to perform the audit to obtain reasonable assurance. Again, we don't give absolute assurance. Oh, we give absolute assurance that these are okay, that these are financial. No, 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 no. We give reasonable assurance. Well, what's reasonable? I don't know. I mean, it could be 95%, it could be 99%, it could be whatever, but it's a reasonable assurance, not absolute assurance. And we only, but whether the financial statements are free from material misstatement. And again, this is the key word. Material. We do not look for all misstatements. We only look for misstatements that are material. Let's see, could I scan those? Yeah, I can scan these. I can scan my notes, no problem. The documents, I think the only documents I have posted right now in Blackboard are the syllabus. So Shante, did you get the email? I don't know if you got the email. If you got the email, it should be in there. Now, if you didn't get the email, I can go ahead and post.
That's why I asked.
I'm sorry?
I don't have an email from you. I just checked it and I don't have it.
Okay. Give me like 30 seconds. I will put them in the course files.
Shante, are you checking your school email, not your personal email?
Yes, I checked the school email.
Yeah,
Oh, okay.
There's actually having quite a few problems with the school email. This isn't my last class. I had 4 or 5 people that I literally had to send them to their private account because they couldn't get anything from their school email. So I think there's something going on. But anyway, let me put those. I should have put those in there before. So let me add those in. Let's see here. Let's take a second. This over here. I was going to show you guys me doing this, but you can see how completely inept I am. I'm going to also throw in the PDF format. So that's yeah, I don't know what it is with the emails. So this will be PDF. But I can definitely scan these. Now, can you get into Blackboard though, correct? I said that.
Yes, I can get into Blackboard. I'm not sure what's going on with the emails because a couple of my other classes are having issues with the email as well.
Yeah, I had and not to put too fine of a point on it, but I had a couple of students couldn't get into Blackboard. The only thing that would show up for the class would be the announcements. And so and they showed me these anyway. So there's something going on.
The email, I opened up a ticket like a week ago. The forwarding isn't quite working because they have their spam filter set to forward out to like mark all outgoing mail as spam. So they're like bouncing the forwarding internally and they haven't figured out how to fix it. And then I'm only getting like part of the mail that even goes in. So like, I think they've got their like spam filtering set to like not allow mail anymore.
No, and actually I had a problem. I had a problem last quarter with it quite a bit. It was last quarter I actually went through it with them, and I remember distinctly though the first day going through the stuff with them is that they said, "Oh no, we got they showed." I said I sent out these emails, and I said, "Well, do you have all the emails I sent out?" Yeah, they showed 3 of them. I think I sent out 15 that day, and only 3 of them that they had records of going through. So I don't, it's been a problem, and I think you're right. I think it has something to do with they're so afraid of being hacked and all that they have on such a lockdown. But at some point, it defeats the purpose of having it, and that's one of the things we talk about in internal control. If I wanted to keep people from stealing my car, I could take the wheels off. Okay, they're not going to steal a car, but I can't use the car anymore. So there is there's a reasonableness that you have to kind of accept if you're going to and that's for any kind of internal controls that you may have. You can put so many controls on this, it doesn't function anymore. So anyway, hopefully they'll get that cleared up. And that's another problem with this whole thing. I don't know if I have students that can't get into the Black. I literally had I think it was 3. I had 3 students that literally could not get their email and couldn't get into Blackboard, even though they're on the list. There wasn't anything like, oh, they weren't on the list or anything. So okay, we will. Let's keep going here. Where am I at? Okay, but yeah, I'll include. I'll scan this. This does not. So anyway, we only look for material misstatement. So for instance, if you find a misstatement for $5 million, is it material? It depends. If it's Walmart, no way, not even close. If it's a smaller company, yeah, very well could be material. But so misstatements are, they are based on the size of the company of what is material. So, is this material or not? It really depends on the size of the company. If it's Walmart, they make this much every hour or something, it's not material. But for a smaller company, very well could be. Okay. So again, this is one of those things that people don't always get. And people even in upper management will find them saying, "Well, we have someone embezzling $200,000 a year for 5 years, and the auditors never caught it." Of course, they didn't catch it; they're not looking for it. And it would probably cost more than $200,000 a year to find the thing. Yeah. So there is some confusion as to what actually auditors do, and it's basically to make sure that the financial statements are free of material misstatement. You don't look for all misstatement, just material. Okay. Okay, well, we'll finish up the audit report, and then maybe we'll take a break, a few minutes, walk around. Let the little dog out. All right. So the second paragraph, so this is still a continuation of The auditor's responsibility. So management's responsibility is actually fairly short. You know, they say management, financial statements, internal control. The auditors, because this is our report, they actually go into it a little more in detail, and that we're actually going to go ahead and tell them exactly what we do, a little more information about what we're doing. Okay, first thing, we're going to obtain evidence. So kind of like going into a court case, we're going to get evidence about the amounts in the financial statements. This evidence is what we're going to use for our opinion. Okay, so we're going to get evidence, and the evidence is going to be what we use as our basis for our opinion. Okay, we also tell them right up front that these procedures are auditor's judgment. And on this statement, whether or not it's due to fraud or error. So whatever makes the misstatement, it's due to auditor's judgment. And, you know, again, is this material? Well, that's a judgment call. Depends on how big the place is and, you know, all that kind of stuff. So auditing, and basically all of auditing is judgment. Even if you say, okay, I'm going to audit to the 95% level. Well, that's a judgment. If you're saying 95% level, you know, why isn't it 99%? Why isn't it 90%? Or, you know, all of auditing is judgment, and you can't get around it. Which is one of the reasons why it's kind of hard to, you know, to learn auditing. So it's a little bit. I'm not sure what it's focusing on. I'm gonna try something a little strange here. Let's try this. It's a little clearer. Okay. Making those risk assessments, the auditor considers internal control. And this is where it's different than a publicly traded company. Then we consider internal control. We do not express opinion on internal control. If it is a publicly traded company, also known as an issuer, they do report on internal control. This is the main difference between an issuer's report and a non-issuer's report. Non-issuer's report, they don't report on internal control. For a publicly traded company, they do. And you may ask, well, why? This is for companies that are not issuers. This is for companies that are generally smaller than publicly traded companies. If you get small enough, they may not really have any internal control. If you go to a mom and pop restaurant, everyone works out of the same cash register. Everyone, you know, Fred does the ordering one day, Amy does the ordering another day, and you know, they don't have internal control. So making a report on it would not be practical for smaller businesses. So publicly traded companies, though, IBM, they should have good internal control. You're going to make a report on their internal control. Okay. And so it says here, look, we express no opinion on the internal control. If it's publicly traded, we would. But this is a report for non-publicly traded companies, so we're not going to issue a report on internal control. Large company, they'll get an audit on the financial statements, get an audit on the internal controls. Not publicly traded, they get an audit of their financial statements. That's it. We also evaluate the appropriate accounting policies, estimates by management. Okay. Down here, it says we believe that our audit obtains sufficient and appropriate evidence. Hey, color. Put a different color in there. Basis for our opinion. And again, this opinion has to be based on the evidence. It cannot be based on anything else. So if the evidence, you know, if the client comes to you and says, look, I'll guarantee, I'll write them, guarantee that nothing's wrong here, and I'll put it in there that if anything is wrong, I'll give you $10 million. You can't do it. It has to be based on the audit evidence. That's all you can use for your report. And the opinion down here pretty much reflects what was going on above. Our opinion. Answer statements reviewed above is unfairly in all material respects. Hey, why don't I have that underlined? I should. Financial position, which is just the balance sheet. Another term for balance sheet. Why they don't say balance sheet, I don't know. And results of operations, which is the income statement. And cash flow, so you're not ending. In accordance with accounting principles. I say, so these are the accounting principles here. Oh, going back to page 2, these are the auditing standards. So on page 2, the auditor's responsibility, the second one there. These are the auditing standards we use. These are the auditing standards we use to do our audit. These are the accounting principles. This is like the financial accounting stuff you had in all your other accounting classes. How do you make the income statement and all that kind of stuff. So these are the accounting principles. This could also say international standards if it was an international, if they used international standards instead of US standards. So for the international standards, everything would be exactly the same, except down here, so we did, except the international accounting standards. That would be the only difference. If it's a single auditor, they have a signature. If the firm would put their stamp on it. They'd tell what city and state they were in, and the date of the report, which is the last day of field work, which we'll talk about later on in the quarter. But basically, it's when you pack up your bags and leave, but you haven't. When you leave the client, and all the work is done, you just have to put it all together. But when you leave the client, that's the last day of field work. So you pack up all your stuff. You're going to go back and formulate your opinion. Well, whenever you leave that place, that's the last day of field work. Okay. You guys want to take a break, like 10 minutes or something? Get up, walk around. Maybe you already are. I don't know. Okay, I tell you what. We'll what time is it? 7:09. We take like 5 minutes. I'll say we'll say be back. Yeah. Be back when I find my paper. Let's say be back at 7:15. How about that?
Okay.
Okay. Okay, let's see here. All right. I'll talk about this a little bit. They talk about a little bit about the assertions in chapter 1. We'll talk about it a little bit. We're not going to go into it too deeply, but they're good to kind of know. By the way, if we're ever in this meetings and you hear something bashing on our door, we got this new little dog that doesn't bark. She like throws herself. She like hits the door, and it sounds like someone kicking in the door. So if you're ever wondering if I'm being attacked or something like that, it's just a little dog trying to tell us to come in. I wish it would just bark like a normal dog. All right. Assertions. They talk about this in the first chapter in the textbook. It's not a bad place for it, but we'll go into it more deeply later on. And that is when management hands you the financial statements, these assertions are assumed to be there for their when they hand it to you. I'll tell you what I mean by that. So these are the first assertions. For instance, completeness, that that the financial statements are complete. When IBM hands you their financial statements, it's assumed, when they hand you their financial statements, it's assumed that they're complete. It's assumed that any obligations, in other words, liabilities, that those are all in there. It's assumed that they have valuations on whatever they need to have valuations on, that those are all in there. So these assertions they're called relevant assertions, but they're really come from management, that when they hand you the financial statements, it's implied that they're complete and so forth. And these are what you actually test to when you do your audit. A few years ago, we broke it up into 3 different categories. And down here, and take the exam, you'll study these and have these all, because a lot of times they'll say, they have them for different ones. This is for ending balances, transactions, and presentation and disclosure. You'll see that a lot of them are the same. For instance, completeness is in all of them. Completeness. So there are some that are in all of them, and there's some that are only in one or 2 of the others. So, for instance, occurrence, if this is for transactions. So if they say that they made a sale, it's assumed that there's an occurrence that happened, and you're going to test to see that an occurrence, like a sale, actually did happen. So these are the assertions that we do testing to. So whenever you do testing and whenever you are looking at management for the financial statements, these are the assertions that you expect that are included when they hand you those financial statements. The only one that's a weird one here is accuracy. We generally never say the financial statements are accurate. But this is for the presentation and disclosure, and that it's accurate, whatever it is that you're doing, whatever it is you're putting in there, for instance, that you're using the LIFO method, that is accurate. So if you're using the LIFO method for inventory, that's accurate. Again, I know this is kind of a brief going over of it, but you guys probably saw this before in your other class. But these are what we actually do audit testing to, these assertions. And generally, if it's not in one of these assertions, we don't test it. Not always true, but down here this is for PCAOB. I think they may have changed this, so I'll have to check and see if they changed these for the PCAOB, which we'll talk about. Okay, so this is just giving you a little bit of background on the on kind of the structure of accounting and auditing in the United States, how we actually do things. The AICPA. The AICPA is just a club. Like the Boy Scouts or the Girl Scouts or whatever. It's just a club. When you pass the CPA exam, they'll send you a letter. Hey, you want to join our club? You can say yes, and they say, okay, send us a check for $300. But so the AICPA is just a club. It's a group of CPAs. So it's a club of CPAs. So the American Institute of Certified Public Accountants, when you pass the CPA exam, they'll say, you want to join our club? You say yes or no. But you can join their club and be part of the AICPA. It's a good group to be with. There's a lot of advantages to being with them. And even though they have annual dues, a lot of times you can save that by a lot by some of the stuff that they have in there. So anyway, so AICPA, it's just a club. Now, it actually ends up being a very important club because they make the Financial Accounting Standards Board, they make our accounting rules. FASB makes the accounting rules. They're loosely underneath the AICPA. There's a separate organization, but the separate organization is under the AICPA. But Financial Accounting Standard Board makes the accounting rules. And we'll find out later that the SEC is involved in this, and we'll talk about that in a little bit. But AICPA, they make the accounting rules. They make GAAP, generally accepted accounting principles. They also make some of the accounting standards for government agencies other than the federal government. So they make accounting rules for government agencies. There's a split between them, between this and the federal government agencies and stuff, but we're not going to get into that in this class, but there is a split between those two. Important to this class, they make the auditing standards. Okay, so it's just a club. They make the accounting rules for businesses, they make the accounting rules for many government agencies, and they make the accounting rules for auditing rules, I should say, for doing audits. For that we're going to be following actually. For this relates to the CPA exam. So they make all of these rules. They also make the CPA exam. Now you're wondering, well, okay, how do they get the? This is just a club. It's like Boy Scouts of America. Boy Scouts of America making accounting rules or something. So, the question is, well, how do they get there? Why are they important? And they are very important. Well, we'll see why they're important in a page here or two. Okay, CPA exam. The AICPA makes the CPA exam. And every state uses it. Okay, so AICPA makes a CPA exam. Every single state uses the exam for licensing CPAs. They don't have to. The states don't have to use those, but they do. They could, Illinois could say tomorrow we're going to make our own exam. We're not going to use the AICPA's exam. They're probably not going to do that, but they could. So every state uses the exam for licensing CPAs. So the AICPA makes a CPA exam, and every single state uses their exam for licensing. So the states actually do not make the CPA exam. The AICPA makes the CPA exam. So, one reason why the AICPA is important is they're the gatekeepers for becoming a CPA. Not directly, but they make the CPA exam and every state uses it. Now, the AICPA does not grant CPA licenses, just like they don't grant driver's licenses. Only the states issue licenses. So the states license CPAs. So Illinois licenses CPAs. The AICPA is just a club. They can't license CPAs. The State Board of Accountancy, they can license CPAs. Another thing is that a lot of times these auditing standards for the states become laws. So a lot of times these auditing standards become laws. Hey, I didn't mean to do that. So, for instance, this page 2 and 3, we just went over the AICPA audit report. There's really unusual things. In college, we usually say, you can't plagiarize something. If you plagiarize something, we're going to, do terrible things to you. When it comes to the audit report, you're required to use this verbatim, or else you can lose your license. Why? Because the states all say, look, you have to use this exact wording the AICPA came up with, or we're going to yank your license. So most classes, they'll tell you, don't plagiarize. In this class, you must. If you don't plagiarize, you can lose your license. So, this is one of those things that even though the AICPA that came up with this, then they have no licensing ability of their own. The states do have licensing, and the states do make laws, and they generally take the rules for the AICPA and say, okay, those look like good rules, we'll make those into laws. So if you don't follow exactly what the AICPA says for this, you lose your license. So even though it's not a government agency, they don't have any. Only the state can take the license away, just like only the state can issue the license. For instance, like a driver's license, only the state can issue a driver's license. But because a lot of times their rules become laws, that's another reason why the AICPA is fairly powerful. Okay, on to page 6. Now, on page 6, the Securities and Exchange Commission, this is for publicly traded companies. Or as we like to call them now, issuers. So they have control over issuers, and they're a very publicly traded. So it's a very powerful organization. And the Securities and Exchange Commission says that publicly traded companies, so issuers, must use the AICPA accounting rules. So again, AICPA, just a club, making their accounting rules. No one cares because they're just a club. Doesn't matter. However, Securities and Exchange Commission, which is a very powerful governmental agency, federal government, they tell people who issue financial statements, you have to follow that club. You have to follow that club's rules when it comes to making your financial statements. And if you don't, we're going to stop trading on your stock and do terrible things to you. So, Securities and Exchange Commission, they say that issuers have to use the AICPA's accounting rules. Even though AICPA is just a club, the SEC says that they have to use, tells all of the publicly traded companies. Now, this is important though. This only applies to publicly traded companies. The only businesses that are actually required to use, but by law, are required to use GAAP, are publicly traded companies. If this is Joe's hot dog stand that only has one, is not publicly traded, the Securities and Exchange Commission has no power over them at all. So if it's a private company, nothing that the SEC can do has any impact on them. Okay. So only for issuers, and they tell the issuers you have to follow these accounting rules that are made by this club called the ACCT433. The Sarbanes-Oxley Act, which I think I have later on in here, made this public accounting oversight board, and they do a few things, but the big thing they do is they register CPA firms to audit issuers. So publicly traded companies. You can't simply walk in and, if you're a CPA, you can't walk in and audit a publicly traded company. You have to become registered to do that. Okay. Chapter 2. Something here. Chapter 2. Yeah, we need to finish this. We'll see. Yeah, we'll see. Okay. Chapter 2. Types of auditors that we have. Now, the ones we've been talking about are external auditors. And those are CPAs, and they must be independent. In other words, they don't work for the company. So for instance, like this, we have, let's say that this is IBM, and here will be the CPA firm. So they are external. These are the external auditors, and they must be independent. And they are outside the company. And the reason they have to be independent is so that they're objective. They're not biased. So, they'll look at the financial statements of so they issue their financial statements. They'll put in their audit report. Oops. And they are not biased. They're not, they're not on the payroll of IBM. So these are external auditors, and they are independent. So this audit report is by outside people, externals that come in and take a look at it. Okay. External auditors, well, there's also internal auditors. And those work inside the company. So in IBM, they will have internal auditors. And those internal auditors will float around and look at different stuff inside the company and look at things. Now, internal auditors are not independent. IBM writes their paychecks. So internal auditors are inside the company. Now, these internal auditors are very knowledgeable. They probably know a lot more about the company than the external auditors. The problem is they could be biased because they are not independent. So even though these people may know a lot more than the external auditors, they're not independent. Okay, so internal auditors, we have governmental auditors. For instance, the IRS. Oh, I should put more room here. I'm not sure why I did that. So governmental auditors are, for instance, the IRS. There's other kinds of governmental auditors too. There's GAO auditors, which are General Accountability Office ones. They work for Congress. There's other ones in there too. IRS is probably the one that's most widely known. And there's forensic auditors, and these are usually people that, these are usually people, a lot of times they'll be involved if there's a crime committed or some type of something that they need more information on. It doesn't necessarily have to be a crime, but when something goes wrong, usually they're the ones that come in and take a look and see what happened. Okay, types of audits. Examination is another term for a financial audit. And this is what we've been talking about, basically. So an examination is a financial audit, and a lot of times those are done by the CPAs. There are other audits too. There is so when you see examination, and this can be confusing when you're going through the CPA exam. When they talk about that they completed an examination, they're talking about an audit. An examination is a financial audit. There's other terms they do. There's internal control audits. Oops. We just look at the internal controls. I'm going to skip a line here. There's operational audits. And those are, they look at the effectiveness and the efficiency of an operation. These are usually to make improvements. So operational audits are these can actually be, these are maybe some of the most extensive audits there will be, is these operational ones, because they can look at, instead of just looking at the inventory and seeing if they have the right amount for the inventory, they might look at the entire operation of how they acquired inventory, how they store it, how it gets priced, how it gets moved, how it, all that kind of stuff. So operational audits are actually usually, they can be very large. I've been on ones that have lasted months. Let's see, operational and forensic audits. And a lot of times that's when there's some kind of a crime or suspected crime. Come on. Okay. Assurance services and attestations. I don't know how far I want to go on this, but there's a couple of different things. There's a review report, which is sort of like a mini audit. It's cheaper. I'll talk about that one for a second. Look for a piece of paper. Okay, it's sort of like this. Let's say that you have a business that needs an audit. They say they want an audit. Their net income is $100,000. So they come to you and they say, "Oh, we want an audit." You say, "Okay, that's no problem. We can do an audit. An audit will cost $40,000." Does that make sense? You're going to pay 40% of your income for an audit? No. So what they do is they might offer a review, which is again, it's sort of like it's not really an audit, but it's sort of like a mini audit. You can think about it that way. They don't do the expensive testing and all that. And, a review might be $5,000. Okay, well, we can swing that. That looks a little more reasonable. It could even be less than that. But, whereas this is too much, a review is more reasonable. There's another type of review, though. It's one of those things about auditing. It's a can of worms. But when a company, a publicly traded company, they'll issue quarterly reports. And those reports they also get a review. They don't get a full audit, but they get a review. And then they have an audit report. So if you're looking at a publicly traded company, they really get 3 reviews for every 1 audit. I know it's kind of strange, but so a review can come in 2 different flavors. A lot of times it's for companies that can't afford an audit, or if it's a publicly traded company, their quarterly data gets reviewed, and then the full-blown audit comes at the end. I have 2 quarter 3s here. That can't be right. And then, at the end of the year, they get a full-blown audit. So that's a review. It's sort of like a mini audit, and it's used to save money. It gives some assurance, but not as much. So a review report is an attestation, and they also have agreed upon procedures. These are probably the 2 most common ones. The agreed upon procedures are when you have to attest to something that is not generally a financial statement. It could be attesting to one number in the financial statement. It could be other things. The one I find to be the funniest is I had a friend who was an auditor. He was an auditor in Texas. He got moved down to Texas. And one of the agreed upon procedures is they had to go and count cattle. They have these huge ranches that have thousands of cattle, and they just wander off. It's this wide open space, and then they kind of, corral them all in, and they get, vaccinated and all this other stuff they do. But anyway, they have to sit there and they have to count the cattle because they don't. It's spread over like hundreds of miles or something. I mean, and all these cattle, they come in, they have to count them because they have to know how many, and they have to say, okay, here's the assurance that, okay, they have 28,000 head of cattle, or whatever it is. So you have these guys sitting out there in, suits, counting cattle as they come through the. All right. CPA firms. And CPA firms cover different sizes. Local firms are usually small firms. They could be, just one person. Yeah, when you pass the CPA exam, you can set up shop for yourself. Oh, there's a farm in Illinois that does that. Yeah, I don't doubt it. It's kind of funny, because and it's huge dollars. I mean, it isn't what you'd think, but yeah, they have these huge fields that are, or ranches, whatever they are, and they herd them all into areas that these people count them, and they literally have people standing around in accountants in suits, marking off cattle as they walk through the door or gate. You tell them not a farm. They walk through a door. All right. So CPA firms, local firms, it could be one CPA. You could have a number of ones. It could be larger than that. The local firms, generally the size of the client goes along with the size of the firm. So a local firm, if you have one CPA is not going to do the audit of IBM. It'd be impossible. So if you have one CPA, so usually this is for smaller businesses. And they may do things that are different. They're probably not going to do a lot of audits. Audits are very expensive. Small businesses aren't going to pay for that. They don't need to. So smaller businesses, they'll do a lot of things like bookkeeping. They'll do the taxes and so on and so forth. But they probably not too much, usually not too much in auditing. Not that they won't ever do it, but it probably isn't their normal way of making money. And even though they're small firms, because it is their own firm, they can, they pick and choose their clients and all that kind of stuff, and they can be fairly profitable. It's just that their clients are different. Not that it's any better or worse than the other ones. Regional firms are usually in a specific region in the state, or they might be in a couple states. For instance, you may do work in Illinois and Indiana because they're kind of close together, and and the businesses and all that kind of stuff. So it's not unusual to have regional firms that will do this, and they can be actually fairly large. There's some firms that are just in the Northwest, or just in the Chicago area, or just on the East Coast, and that you can have dozens, if not hundreds, of partners in some of these firms. And same with national firms. National firms usually have are in most states. And they can have hundreds or even up to thousands of CPAs in there. Lots of partners and stuff in there. And again, these kind of go with larger and larger firms. These national firms, they'll definitely do audits. Regional firms will probably do a few audits, depending on how specialized they are. When I graduated, I got an offer from a kind of a regional firm that did governmental auditing. And so even though they were a regional firm, small, the big chunk of their business was audits, because they did all these governmental audits. They're based down in Springfield. But all right, the big three, no, not big three, big four, big four are firms, international firms. These are firms that if you're going to audit, say, Coca-Cola, it's all over the world. You can't have these places that are simply based in the United States. They may have significant operations all over the world. So you have to have companies that are audit firms that are all over the world, and that's what these four come into play. They're the largest ones. They'll have the largest clients. They'll have yes, the CPA exam also has cybersecurity and SOC audits. They'll talk about SOC audits 1 and 2 are, I'm just reading off the thing here from Jason. But yeah, so large clients, yeah. But yeah, the CPA exam also will have, and actually the whole thing is a lot of it is about they're kind of switching the exam to be more in tune to operation cycles. Are the big four worth the hype? It depends. Big four have strong name recognition. If you're in a big four firm, it can definitely open some doors for you. As to whether it's a good fit, that's another question. They work you to death in those firms. It's very competitive, and actually we'll talk about this in a minute. Any CPA firm will bump you up a little bit if you work for them, as far as your career is concerned. And it's always been that way. So just in general, any working for any CPA firm generally gets your foot in the door. And if you work for a CPA firm, a lot of times you see jobs advertised, they'll say, they want 2 years of CPA experience or 3 years. 3 years is a little high, but a lot of times they'll have, they like to see CPA firm experience. So being a CPA now, as far as to my thinking, there's actually some regional firms that their names carry as much weight as some of the big four. But yeah, they, as far as they're worth it, they generally have more name recognition, and it's even more in my day. In my day, it was the big eight. They all kind of like merged together though. So yeah, and it was the same thing back then. Is it generally is a little more name recognition stuff to it. Are they worth it? I think any CPA firm, if you want to go into a CPA firm, that it's a good deal. At least it's a good stepping stone. It's hard work. They'll work you. I mean, 60, 70-hour weeks are not uncommon. It's not uncommon to work on Sundays and during the busy seasons and all that. So any type of work like that it's difficult, but it also kind of jumps you up in that you might come out with 2 or 3 years under your belt in the CPA firm and be given opportunities that usually only come about if you've been in a position for 10 years. So it does kind of leapfrog you into the front, or at least for that period of your career, it might help. But yeah, it's hard to say. I'll put it to you this way: if you didn't get into a big four firm, or maybe you don't want to get into a big four firm, that's also somewhat reasonable if you don't want to be worked to death. Going into the smaller firms is not a bad idea, and quite honestly, it may even be more opportunities in some of the smaller firms. Just because if a lot of times the rotation of people becomes difficult. It becomes difficult to move people to the upper branches and actually have them get enough background to run audits and things like that. Whereas if you're in a smaller firm and you're doing smaller audits, you can actually, learn quite a bit from all different angles, from cash, from inventory, from fixed assets, from everything. You can learn those because you're going to be doing them because there's fewer people. So it is possible that you actually learn more from a smaller firm than you would from a big firm. It's tough to say, as to what's the best place to go. And it probably depends on the person and what you really want to do and that sort of thing. But any CPA firm experience is good, just in general. I mean, big, small, or whatever. Again, it can be tough, but where are we at? Ooh, we may finish this. Yeah, we're not going to finish it. But I do want to finish up the CPA firm kind of organization thing, and then we'll call it a day. Yeah, we'll leave it a page or so. We have some for next time. This stuff's a little bit dry, so it's a little tough to hang in there for 2 hours doing this. But anyway, so CPA firm organization. Now these are the CPA firm organization. This is one of those things that is, it may not be set in stone, but it's pretty close. And generally, they start you out as a staff assistant or associate, and these are 0 to 2 years experience. The larger firms, I'm not sure. They probably pay 60, 70,000, something in there. I would imagine it may even be more than that. They start you out with, and so you start out as a staff assistant or what they call associates. During that time, you're expected to sit for the CPA exam. So they'll hire you. You know, you don't have to have a CPA before you walk in there, but they'll give you the the Becker review and whatever, and you're usually expected to pass the CPA exam in that 2 years. Right. So 0 to 2 years experience, you're expected to pass the CPA exam in that period of time. And when you go up to the next level, say 2 to 5 years, this would be years. You'll be the senior in charge auditors. These are the people that run the audit. The senior, sometimes called the in charge. This is kind of an old term, but you still see it. The senior auditor, the CPA exam is generally aimed at these people, because these are the first ones that are going to be. This is the first time that you're actually going to use all this stuff you say for the CPA exam. If you did it based on these people, what do these people do? They do whatever the senior tells them to. So this is when you really start using your what you learn. And so this is the CPA exam is focused on these people. Oops. I don't know. I'm making my new alphabet here. CPA exam. Focus, Mark, focus. You must be a CPA. You cannot be a senior if you're not a CPA. And by the way, you say, well, what if the place isn't organized like this? The standards, the way they're written are, it's either organized like this or whatever organization you have to put them into these categories somehow. Yeah, I know that sounds strange, but this is one of those kind of strange things that these are actual categories that the AICPA and the licensing people are focused on. You cannot run an audit unless you're a CPA. Now, up here, if you don't pass a CPA exam, guess what? You can't be that. So you get 2 years here to pass the CPA exam, and then you can move up to these. All right. Now, going to be a manager. Manager is probably 5 to 15 years. And they'll probably run, let's say 2 to 5 audits, depending on how big they are. So they'll have, 2 to 5 seniors underneath them doing audits, and they'll be overseeing all of those people. And obviously, they must also be CPAs too. You can't get to here unless you go here. So, and partners. Probably 12 years plus. There's some making 10, but it's fairly unusual. Oh, I never gave them dollar amounts here. Senior auditor is probably around 100,000 maybe even a little more than that, depending. Managers probably up to 150 to 200,000, and partners, they can go quite a bit, 400,000 to $1 million a year. And partners will oversee a number of audits. And the partner's job, though, is a little bit different than these other people. This is almost like a high-end sales job. And the partners, their job is to get clients. So their job is to get clients. And these are very personable jobs. They're people that know a lot of people in business and so forth, the higher ups in companies, and that they can get the business to bring those in, those clients in. So it's at some point, here the managers start developing relationships with people in the business, and then up here is where they actually start getting clients to come in. Pays a lot of money. You have a lot of expenses. It's not unusual to pay $50,000 in golf club memberships and stuff, because you're gonna be taking clients on the golf course and trying to get business and so on. So anyway, that is kind of it. Now there is something that is at first seems a little bit sinister to this, and that is in a CPA firm, it's up or out. If they can't, you'll notice that I didn't say 0 to 50 years here. It's 0 to 2 years. If you don't pass CPA exam, or they don't think they can bump you up to a senior, you're out. Same thing down here. You get to the 5 years as a senior. If they can't make you a manager, you're out. Same thing with partner. If they can't make this manager into a partner, they're out. And you say, well, why is that? That seems kind of cold. Well, it's because of this. Here you have your auditors. I should say associates. And up here you have your seniors. And you have your managers. And then you have your partners. Partners should have both these. Now, here's why it's got to be up or out. You need to have partners, or else, scratch that. You need to have partners, or else you cannot, it was not going to survive. And by the way, this is any partnership. If you're in a law firm, this is the same thing applies. If you cannot move people up, they're out. So if let's say you have someone who's associated, if they can't move up, they move up. You say, well, why is that? That seems very cold. Why not? Because here's the problem. Someone you can't move up, okay, so they stay there. Other people get moved on. Well, eventually, all these avenues to get up to partner are going to be plugged by people who are probably very competent, but they can't be moved up. And because they can't be moved up, this is going to die. Partners don't live forever. So it's either up or out. So if they can't make you into a senior, you're going to be out. Now, being out isn't usually that bad. CPA firms will try to get non-promoted into their clients. So, for instance, if they're auditing IBM, they might say, okay, they can't move you up. Wherever you are in here, they can't move you up. they'll say, you know, I got this person, and you know, good, does great work, does all this stuff, but we just don't have a spot for them up there. You know, oh yeah, send them over. We love people from CPA firms. So they try to get their people that come out of their organization, the CPA firm, into their clients. So if their client's IBM, they may say, you know, you get that auditor, you know, oh yeah, you know, oh yeah, she's a great auditor. Yeah, okay, well, you know, we don't have a spot for her to move up, but you know, you get, oh yeah, you know, so they're usually pretty excited to get these people. Now you say, well, why does CPA firm care? Why don't they just tell them to pack their bags and go? Well, you want to have that relationship between IBM and the audit. You know, if you're their auditors, you want to have that relationship and keep that relationship going. And one way is to put your people in IBM, so that when it comes up to who does the audit, you say, oh well, it's always, you know, whoever it is. So even though it sounds kind of cold up or out, actually, and usually a lot of times you'll get a bump up in pay, and you'll work half the hours. So a lot of times the CPA firm, the benefits are not from being in the CPA firm. A lot of times it's when you leave the CPA firm, you get a nice job, good salary, and you move up, you know, up the line a little bit quicker, and you know, you work much less than you work in the CPA firm. So being kind of shoved out the door of a CPA firm, it sounds terrible, but in a lot of cases it's not. A lot of times it's welcome. All right. Any questions on that? All right, I think we'll stop there. So what was that page? Here we go. So we'll talk about these other things next class, and we'll probably start in. On the sampling stuff. May do a problem or two out of this, but the textbook. We'll see if we get that next week. No homework, and that means so next week it'll be clean. We'll just finish this up, and you know, we'll definitely get through the handout next week, and probably at least get through the one of the first statistics parts, and then we'll see where we're at from there. Any questions? Okay, well, let's call it a night then. And if you do have any questions, you can feel free to email me. Oh, another thing is I'm in Blackboard under my. Well, actually, it's even in the it's in the syllabus too. But if you need to contact me, my my personal email is there along with my school email and my cell phone too. So if you can't get through on an email, you know, you can call me or text me. If the phone's near me, I'll pick up. If it's not, you can leave a message or send me a text or whatever. But my only warning is that sometimes I leave my phone in the car, which I don't try to do, but sometimes, yeah, sometimes it happens. So anyway, any questions on that? Okay. Well, if there are no questions, we'll call it a night again. Nothing due for next week. We will we'll pick up where we left off, and get started on the sampling. We'll do probably the sampling we'll probably start out with is the easiest one, which is the classical sampling. So anyway, any questions?